have them, you got to buy them. And so the higher that dollar goes up, the more expensive it is to get them, which means the more money you're putting toward debt servicing. Why is that a big issue? Because what has been going on for the last few years? Just think about Michael Saylor, all the debt he's issued. And now he just took out a loan, right? He just took out a loan for MicroStrategy to buy more Bitcoin, right? So taking on more debt. But that's not just him. It's with everybody, not just with Bitcoin. It's with everything. You have all these companies that thought they were going to be backstopped by the Fed and no longer, right? But they've taken on all this debt over the last 2 years. What happens now? All of a sudden, they have to pay back that debt, and they have to pay it back with more expensive dollars. So if they remain in business, they're not going to have enough money to really be able to expand and produce more. Many of them are going to go out of business. Again, higher unemployment rates. All this leads into that deflationary spiral that I've been talking about for the last 2 years, maybe 3 years. Talking about potentially heading into, right? Now, can I guarantee we're going to have deflation? No, that's still what I think is going to happen. Secondary possibilities I've talked about prior is that maybe we get stagflation. Stagflation is that persistent higher rising inflation and lowering ability to be able to buy things, right? But for now, I still think we're probably going toward deflation. Again, with all these things I keep talking about. So we've got all these things happening, guys. And people are out there talking about hyperinflation as if they understand what it is. So that's kind of where we're at with that. Let me see here. Kind of catch up with you guys here. Terry Ryder says the current housing market must be so demoralizing for entry-level buyers. Every rate rise, you have to lower your hopes and price range. Exactly. And prices are already pretty high. Yeah. It's a tough thing if you're just trying to get in and buy a house. And rent, of course, followed up, right? Again, I'm looking right now. You guys know that, right? And so I know what the prices are. I know what we're doing. I know how fast houses are moving, even in my price range, right? And so, yeah, it continues to really happen out there. But we do notice there is a significant slowdown in the $250,000, $300,000 and lower range, which is your lower end, which is what you expect, right? So the people hit hardest by the things that are going on with the rising prices and everything are those at the lower end of the income spectrum, right? And so it's going to show up in the housing first at that area. And so I brought that up probably the last few weeks. I think it was a week or two ago that we've already seen that. So yeah, I got a lot of that going on there. Let me kind of catch up with you guys here. Let's see here. Oh, did y'all lose me? Well, geez, I just talked a whole bunch for nothing there, I guess then. Anyway. Hey, Carpio, what's up, man? Good to see you here, buddy. Let me see here. Wham, bam, slam. Did you touch on the yield curves today? I didn't today. That was what I was just about to say here. It's something I've talked about last week. And then what I've talked about previously leading into. So you guys that have been following me, you'll know last Q4, as Q4 came in last year, October, November or so. I guess October, I was talking about the inverted yield curve and how we had the one that doesn't really mean anything happening back then. And I said, what we need to watch for are the 2 over the 10 and the 3 month over the 10. I said, those are the big ones, right? And I said, watch for them to happen probably around Q1, maybe Q2 of next year, which was this year. And of course, as you guys, unless you've been hiding under a stone, you might have heard that the 2 inverted over the 10. And so that just happened here recently. Now that's important because what that says is generally you should have a larger interest rate expectation with a longer term bond because your money is sitting there for a longer period of time. It's not active for a longer period of time. You have to be compensated for that. The problem is when your shorter term interest rate rises above those longer term ones, it tells you that the market is fearful about what's going on and they're scared. So they're demanding higher interest rates to compensate for them putting their money, right? And so that's what happens with that shorter end over that longer end. And that's what we're seeing right now. 210, then 310, right? 3 month over the 10. So now, if we look over the last 50 years or whatever, generally it's led when you have the 2 over the 10, especially the 3 month over the 10, the 2 year over the 10, especially the 3 month over the 10 year inversion, it's led to a recession, right? And so the average recession time is about 18 months. So the last time the 2 over the 10 happened was 2019. And then 2020, we had March of 2020, that drop there, right? Now, because it has an average time of about 16 to 18 months, that doesn't mean it's going to take that long. And I would argue with everything we have, we're already headed that way, right? So a much shorter time period on this one. But, you know, it also doesn't guarantee that it's going to happen. There have been some times where it hasn't happened. But I think everything we see, everything I've talked about week after week here, all these different metrics and things that I show you guys, I think they're really leading up to this big kind of, you know, top being in kind of thing. And if we're lucky, all we get is a recession, but I don't think we're going to get a recession. I think we're going to get a bigger depression type thing. Now, what does that mean? Well, there's 2 ways that can take place. That can mean a sharp sell-off, a sharp, deep sell-off, or it could mean an elongated sideways. So a shorter sell-off, but elongated length of time. And if it's a depression, I mean, you could be looking at 20, 30 years of it, potentially 40 years even, of it kind of doing it. If you guys will remember, coming out of the Great Depression, let's see here. Just kind of get over here. So the Great Depression, this is the monthly here. Here you go. There's your Great Depression, right? So it took us, it finally hit the bottom over here in July of 32. It did not reach this previous high up here. I'll just kind of throw a little line on there about where it's at. Oh, gosh, that's close enough, whatever. Until over here around November of 54, guys. This is a bear market. 32 to 54. 22 years. Okay? So we could see something play out like that, right? The drop from 29 to 32 was 3. This is 3 years of drop. 3 years of decline. 3 years to drop 89%. So we'll see what happens with this one. But again, same idea. It could take a while to continue up through there. All right? TV Canal says, when I see the U.S. oil, it starts to look like 2007, 2008. Yeah, so let's pull that up here real quick, guys. Again, why is oil so important? Because usually oil, like the dollar, kind of tells you that that the economy is kind of topped out, right? Because remember, oil isn't just transportation, isn't just fuel, but it's all the plastics, it's jet fuel, you know, it's all those things, right? Especially plastics. Plastics is production, right? If you've got a drawback in production, you've got less demand for oil, right? So when you see that coming back, that's often what we're looking at there, right? So where are we at with oil? Now locally here, I've got us topped out back over here, likely in beginning of March there, first week of March, end of the first week of March there, up there around $130. Now, as you'll see here, the all-time high was July 11th, 2008. It was 147.27. You guys remember buying gas back then? Yeah, I do. But what is significant about this? This is right as the great financial crisis really started kicking in, Lehman going under, everything else, right? And so here we go, possibly topped out right here now. Looking, I've got wave 1 down, wave 2 up, and then locally wave 1, 2, and maybe 1, 2 here heading down. So looking for this 1, 2, 1, 2, 3, at least down here around 79.40. Remember, big picture. This is that big picture for oil, guys. May 2020. First time it's ever dipped below negative. Dipped below zero. And actually closed below there. It went down to like negative $42 a barrel. People paying people $42 a barrel to take that oil. So we've run up now for almost 2 years, guys. Next month will be 2 years. a month from now. Make contracts. If you don't think it needs to pull back, you're not thinking. And so we should at least see a pullback toward this higher volume node around 50 bucks. Quite potentially even more so. Might even see it come back lower here. Maybe even to 30 or something like that, at least. But nonetheless, the idea is there was the all-time high up there, and here we're getting close to it, and now we're rolling over and coming back, I do believe. And again, so when you look at what's the economy doing, everybody talks about inflation. Again, the hyperinflationistas, right? So the only thing that can keep them going is, one, if oil continues rallying higher, because that's the great tax on what you're doing, right? Because it's in so many things. Two, if housing prices continue higher, right? Those are the two big things. And both of those things seem not to be happening. Again, oil appears to already be topped out. Housing appears to be topping out. So if you don't have those two things, how do you get to hyperinflation? You don't. But the other big thing they don't think about is you can print everything you want. You can have all this monetary creation coming out of the bank. All you want. This is fractional reserve banking, right? But as long as you have continued demand, you're not going to get to hyperinflation. Now here's the thing. Inflation in the 40s, inflation in the 70s was a lot larger than what it is now. Now people are going to get on and go, oh, but it was done differently. It's always done differently, guys. The whole idea of CPI is to bring into it those things that, changing desires, changing needs, changing wants. It's to put that in the basket and take out those other things that aren't so strong with people, that people really want anymore. Okay? So there we go. So you've got, okay, so what? The Fed printed this money. Okay, so what? Now it has to make it through the banks or through the government, right? Some of it came out and about. People paid off debt. Paying off debt is disinflationary at least. Okay? You're not taking out more credit. Taking that money, putting it in the bank is disinflationary at the least, potentially deflationary. Again, that's dollars put into the bank, just like dollars paying off debt, that aren't going out there chasing goods and services. So there's a lot more inputs to this than people are out there with their little, sound bites yelling and screaming at the top of their lungs. But again, this is the same thing that comes every single time, and they just don't realize it. And you can tell them that, and no, this. It's the same thing people said last time. Oh, but it's different this time. No, it's never different. It's never different. It's always the same. Until it isn't anymore. So, again, I can't guarantee we won't get hyperinflation, but it sure as heck seems a lot less likely than hyperinflationistas, want it to be. And so, again, people have been romanticizing the death of the dollar since the 70s, since Bretton Woods. Funny thing was, we were already, from the 50s coming up, the dollar was already the de facto kind of world reserve currency along with gold. Back in the 50s. It was already at that point. Bretton Woods just made it so it was by itself. But who knows that? Who talks about that? Nobody talks about that. Especially not your armchair hyperinflationistas, right? So yeah. So that's all there. So that's kind of where we're at with that. If we look at what's going on with the stock market, right? So we've got the Nasdaq composite here. Again, the idea that it likely topped out back over here in November of last year, November 22nd of last year. We've been on a downtrend since then. I've got a 1 and potentially a 2 done here at the 61.8 retracement. Solid wave 2, right? Flat correction. Locally, we've got the first 1, 2 potentially done. A breakdown below wave B here at 14,161 and 61 cents. It's going to add confidence to that and suggest that wave 3 here is in progress to a minimum expected target of 13,630 and 75 cents. So that's, a lot of tech in there, right? So now we can move to the S&P, which is not as tech heavy, right? This is the E-minis, the futures contracts. And so again, looking at the likelihood that we topped out back over here in January, Okay? Again, and what did I tell you guys before we actually got these what I believe are the tops in here potentially? Remember, prior to that, we were following how the Nasdaq was leading everything, right? And how it was just a few tech stocks, Tesla, Apple, Amazon, Microsoft, that were kind of holding everything up, right? And I kept talking to you guys, we kept looking at how it was shrinking. The number of companies making new higher highs was shrinking, right? New 50-week highs was shrinking. And they were becoming these more dominant tech players, right? And I said, well, what's going to happen most likely is we're going to see it happen in the Nasdaq first. We're going to see that top kind of come in the Nasdaq first, because